Hello everyone, welcome back to the channel. Today, we're diving into 20 crucial personal finance rules that can transform the way you manage your money. Understanding these rules can help you achieve financial stability and grow your wealth effectively. So grab a notebook, get comfy, and let's get started.
Now, I'm sure you've heard of budgeting before, but the 50-30-20 rule takes all the guesswork out of it. This rule is all about dividing your after-tax income into three main categories: needs, wants, and savings. 50% of your income should go towards your needs, and this includes essentials like rent or mortgage payments, groceries, utilities, and transportation. Then comes the fun part. 30% goes towards your wants. This is everything that you don't necessarily need but brings joy to your life, like dining out, entertainment, hobbies, you name it. And finally, the most important part, 20% goes straight to savings and investments. Now, I know that sticking to a budget can be tough, especially when you're first starting out, but trust me, the 50-30-20 rule makes it so much easier to manage your money and prioritize your financial goals.
One of the biggest mistakes people make with their finances is waiting until the end of the month to save whatever's left over. But here's the thing. There's usually not much left, right? That's why I'm a huge advocate for paying yourself first. This means that as soon as you get paid, you immediately set aside a portion of your income for your savings and investment goals. When you prioritize saving and investing, it forces you to be more disciplined with your spending and find creative ways to make your money stretch further. Plus, when you automate this process, it becomes effortless. You can set up automatic transfers from your checking account to your savings and investment accounts each month.
Life is full of surprises and not all of them are good, right? That's why it's crucial to have a financial safety net in place. An emergency fund is essentially a stash of cash that you set aside specifically for unexpected expenses, like medical bills, car repairs, or even job loss. Your emergency fund is there to protect you from financial disaster, so it's important to keep it separate from your regular spending money and only use it for its intended purpose. A good rule of thumb is to have 3 to 6 months' worth of living expenses saved up.
Let's face it, debt can be a major roadblock to achieving your financial goals. One of my favorite methods is the debt avalanche method. With the debt avalanche method, you focus on paying down your debts with the highest interest rates first, while still making minimum payments on your other debts. By tackling the debt with the highest interest rate first, you're minimizing the amount of interest you'll accrue over time. It's a more strategic approach that can save you a significant amount of money in interest payments.
Now, while the debt avalanche method is great for saving money on interest, sometimes you need a little extra motivation to stay on track. That's where the debt snowball method comes in. This method focuses on paying off your smallest debts first, regardless of the interest rate, while still making minimum payments on your other debts. You gain momentum as you start knocking out those smaller debts, which gives you the motivation to keep going and tackle the larger ones. Ultimately, the best method for you depends on your personality and financial situation.
We've all been there, right? You're scrolling online and bam, you see something you just have to have. But before you hit that buy now button, I want to introduce you to a simple but powerful rule that can save you a ton of money, the 30-day rule. Whenever you're tempted to make an impulse purchase, especially for something that's not absolutely necessary, just hit the pause button and wait for 30 days. You'll be surprised how many times that initial urge to buy something fades away after 30 days.
Remember the pay yourself first principle we talked about? Well, automating your savings takes it to the next level. By setting up automatic transfers from your checking account to your savings and investment accounts each month, you're essentially making saving a non-negotiable part of your financial routine. The beauty of automation is that it removes the temptation to skip saving altogether. You don't have to think about it. You don't have to remember to do it. It just happens automatically. Trust me. Automating your savings is one of the easiest and most effective ways to build wealth over time. It's like having a personal finance assistant working for you 24/7, making sure you're on track to reach your financial goals.
You can't improve what you don't track, right? The same goes for your finances. Tracking your spending is crucial for understanding your financial habits, identifying areas where you might be overspending, and making informed decisions about your money. There are tons of apps and spreadsheets available that make tracking your spending incredibly easy. You can even link your bank accounts and credit cards to automatically categorize your transactions. The key is to find a method that works for you and stick with it.
Now, if you're looking for a more hands-on approach to budgeting, I highly recommend checking out the envelope system. At the beginning of each month, you withdraw cash for different budget categories, such as groceries, entertainment, and transportation. You then put that cash into separate envelopes labeled with those categories. Once an envelope is empty, that's it, you're done spending in that category for the month.
Now, this rule is all about being more intentional with your spending and cutting back on unnecessary expenses. Discretionary spending refers to any expenses that aren't absolutely essential. By identifying areas where you can cut back on discretionary spending, you'll be amazed at how much money you can free up for your financial goals. Start by analyzing your spending habits and see where your money is going. Remember, small changes can add up to big savings over time.
Let's be real. Budgeting often gets a bad rap for being restrictive and boring. But trust me, a well-crafted budget is actually your roadmap to financial freedom. It's about taking control of your money, not letting it control you. There are tons of budgeting methods out there, but the key is to find one that works for you and stick with it. Remember, your budget is a living document, so don't be afraid to adjust it as needed.
You know, one of the biggest myths out there is that you can't negotiate your bills. But trust me, you absolutely can. From your internet and phone bills to your car insurance and even your rent, there's almost always room for negotiation. The key is to be polite, persistent, and prepared to walk away if you're not getting a fair deal. Remember, the worst they can say is no.
It's a common trap. You get a raise or a promotion, and suddenly, you feel the urge to upgrade your lifestyle. But before you go on a spending spree, let's talk about the importance of avoiding lifestyle inflation. Lifestyle inflation is the tendency to increase your spending as your income increases. Remember, the more you're able to live below your means, the more money you'll have to invest in your future.
Retirement might seem far away, but trust me, it sneaks up on you faster than you think. That's why it's crucial to start saving for retirement as early as possible. If your employer offers a retirement savings plan, such as a 401(k) or 403(b), take full advantage of it, especially if they offer employer matching contributions. If your employer doesn't offer a retirement plan, or if you're self-employed, consider opening an individual retirement account, such as a traditional IRA or Roth IRA.
You know, when it comes to investing, diversification is key. It's all about spreading your money across different asset classes such as stocks, bonds, real estate, and even alternative investments like cryptocurrencies. The idea behind diversification is that if one asset class isn't performing well, the others can help cushion the blow. It's about managing risk and protecting your investments from market volatility.
You know, not all debt is created equal. High-interest debt, such as credit card debt and payday loans, can be incredibly damaging to your financial health. If you're struggling with high-interest debt, make it a priority to pay it off as quickly as possible. Consider strategies like debt consolidation, balance transfer cards, or even seeking help from a credit counseling agency.
Let's face it, no one likes paying taxes. But the good news is that there are legal and ethical ways to reduce your tax liability through careful planning. Tax planning is all about being proactive and taking advantage of available deductions, credits, and strategies to minimize your tax burden. Some basic tax planning tips include keeping track of your expenses, maximizing your retirement contributions, and exploring potential deductions and credits.
We never know what life has in store for us, right? That's why having adequate insurance coverage is crucial for protecting yourself and your loved ones from financial hardship in the event of an accident, illness, or other unforeseen circumstances. There are various types of insurance, including health insurance, car insurance, homeowners or renters insurance, life insurance, and disability insurance. Each type of insurance serves a specific purpose, so it's important to assess your individual needs and make sure you have the right coverage. Now, I know insurance can seem like an added expense, but trust me, it's better to be safe than sorry.
Staying organized might not sound like the most exciting topic, but trust me, when it comes to your finances, organization is key. Keeping track of your financial records, such as bank statements, investment accounts, tax documents, and insurance policies, can save you a lot of headaches down the road. Not only does it make tax time a breeze, but it also helps you stay on top of your financial situation, track your progress, and make informed decisions about your money. There are various ways to organize your financial records, whether it's using a traditional filing system, scanning documents and storing them digitally, or using a personal finance software that helps you manage all your accounts in one place.
Just like a car needs regular maintenance to run smoothly, your finances also benefit from regular checkups. Regularly reviewing your financial situation allows you to track your progress, make adjustments as needed, and stay on track to achieve your financial goals. During your financial reviews, take a look at your budget, your savings and investments, your debt levels, and your insurance coverage. Remember, your financial situation is always evolving, so it's important to stay adaptable and make adjustments as needed.
So there you have it, 20 powerful personal finance rules that can transform the way you manage your money and set you on the path to financial success. Start by implementing 1 or 2 rules at a time and gradually incorporate more as you become more comfortable. The most important thing is to take action and start taking control of your financial future. Thanks for watching, and don't forget to like, subscribe, and turn on notifications for more financial tips.